If you want to understand just one thing about market structure that can completely transform your trading style, it's the leg. In this video, we're going to do something that will help you open a chart and instantly know where you are in the move, when it's the right time to trade and when it's not. Let's explore the core of the trend together, legs and their deadly zones, which are the main building blocks of the market, and teach the critical areas that cause price reversals. See you after the disclaimer and intro. Welcome back, traders. So let's get started. Trend components: pullback, leg, and swing. The smallest component of a trend is a correction or pullback, which usually has a length equal to 1 ATR of the structure's time frame. Several pullbacks are marked on the chart. You can find other pullbacks yourself. Each leg starts from a movement base, which can be a pullback. Every leg equals 3 ATRs of the time frame. In fact, each leg equals 3 standard candles in one direction, and standard candles have a length equal to 80 to 120% of the ATR of that time frame. Therefore, each leg must be at least equal to 3 times 80% of the ATR of the structure time frame, which is 240% of the ATR of the structure time frame. Legs can vary in shape based on movement strength. Next, after introducing trend components, we will introduce types of legs and their important zones that cause price reversals. This is the most important part of the video and can completely change your view of the chart. In this chart, all legs are marked. Note that higher time frame legs are composed of legs from lower time frames. A leg of one time frame can appear as a pullback in a higher time frame. Pay attention to this leg, which belongs to the 1-hour time frame. This leg appears as a pullback in the 4-hour time frame. Also, the combination of these 3 legs forms a 4-hour leg in the daily time frame. From the combination of a pullback and a leg, we get a swing. That means 3 units of movement and 1 unit of retracement. And from the combination of swings, a trend is formed. Pay attention to the marked swings on the chart. Swings are placed next to each other and form trends. Types of movement legs. Legs are divided into 4 categories based on momentum: weak leg, stronger leg, and spike. Weak leg. These legs have a lot of noise, and the candles cover each other and move like CP. These types of legs move at an angle of about 15 to 30 degrees. The number of candles forming these legs is high, and trading within these legs results in a lot of capital lock-in. Strong leg. Movement between 30 to 45 degrees. Candles are aligned but do not close beyond each other. Noise is present but minimal. Stronger leg. Movement between 45 to 60 degrees, no noise, and the leg is formed with candles aligned in the same direction. Spike. A spike leg is actually formed from one spike candle that alone creates a leg, and since it's just one leg, it has a 90-degree angle. You can even see these angles in your own fingers. Important note: as we said before, each leg is equal to the length of 3 standard candles, and since each standard candle is 80 to 120% of ATR, then each leg should be about 240 to 360% of the ATR. But when we have a stronger leg or spike, since there is no noise or correction to segment the leg, this leg can have a length of more than 360% of the ATR of the structure time frame. However, it must be less than 240% of the ATR of the higher time frame, because otherwise, the leg belongs to the higher time frame. Look at the chart where this leg's length is more than 360% ATR, but we can consider this leg to belong to the same time frame. And since its length is less than 240% of the ATR of the higher time frame, it doesn't belong to the higher time frame. Pay attention to the drawn chart. With a little focus and observing the movement angles, we can understand the power of the legs. Weak legs move with a shallow slope, and the stronger the leg, the sharper the movement angle. And to have proper trades, we must use strong, stronger, and spike legs. In the future, we will teach how to trade legs with suitable momentum. One method to detect momentum shifts is by using the ATR indicator, which we have previously explained in full in a video. You can use ATR with period 3 and 7. When ATR 3 is below ATR 7, it means the price has been compressed over the last few candles, and higher momentum is expected in upcoming candles. Also, if ATR 3 is above ATR 7, it means there was high momentum in recent candles, and now the price is entering an ATR-based correction phase and will move more compressed. Important leg zones. Generally, legs have several very important zones that we can identify using Fibonacci extension. These zones include 23%, 33%, 50%, 62%, 78%, and 89%. These zones are marked in the structure timeframe. Then we go to the trigger timeframe and find the desired node in that zone. You'll see how beautifully price reacts to these nodes. As previously explained regarding pivots, to form a pivot, the node in the last third of the leg must be engulfed, which we had defined as the 33% zone. But in this video, I want to explain a key point about this. If a leg that forms is between 240% and 360% of the ATR of the respective time frame, and price can engulf the 23% node with a maximum of 2 reversal candles, price can react to the FTC zone and we can enter the trade, with a minimum expected movement toward the next node. But if the leg length is more than 360% of the ATR of the same time frame and less than 240% of the ATR of the higher time frame, the price must definitely engulf the 33% node for us to consider it a pivot. Setting targets. We can set targets sequentially based on upcoming nodes. Suppose the price, after engulfing the 23% node, returns to the FTC. We enter the trade at FTC and expect the price to move in order toward the 33%, 50%, 62%, and 78% nodes. So, we place the stop loss behind the FTC node and targets at the start of the mentioned nodes. To clarify this, look at the chart. First, we identify the upcoming nodes using Fibonacci. Then, we go to the trigger timeframe and consider pullbacks and consolidations in the marked zones as nodes. After engulfing each node, price advances to the next node. If that node is also engulfed, it retraces and then moves to the following node. In the chart, after engulfing the 23% node, price returns to FTC and then moves up to the 50% node. So, to find the future price path, we need to specify the time frame for the legs. In each leg, using Fibonacci retracement and the mentioned percentages, we mark the important levels in the time frame of the structure. Then, in the trigger time frame, we identify the nodes in those areas. If the price engulfs any node within a leg, we expect that after a retracement, it will continue its upward path to the next node. All right, friends, this section is done. What you learned today wasn't just a strategy. Now, you can read the chart like it's speaking directly to you. Legs, reversal zones, nodes, momentum. They all come together to form a system that is testable, repeatable, and reliable. Practice, backtest. If you have questions, drop them in the comments. And most importantly, if this video truly helped you, hit that like button so YouTube shows it to more traders. And remember, we're here to trade together, not alone.